Welcome to CS School, and today we are going to learn AS5. Okay, so AS5 is all about net profit or loss for the prior period items, which we all call as PPI. Okay, and changes in accounting policies. Okay, so the heading is this much, but in this AS we have to learn these six concepts. Okay, we have to learn all these six concepts. One is profit and loss from ordinary activities. Second is extraordinary items. Third is exceptional items. Fourth one is PPI, or which is known as prior period items. Fifth one is changes in accounting estimates, and the last one is changes in accounting policies. Okay, now, so basically in this AS5 it is all about disclosures or classifications. Okay, how to disclose things and how to classify things, this AS says all about. Okay, so the disclosures for all of this is mostly the nature and amount. We have to disclose the nature and amount of ordinary activities, extraordinary items, exceptional items. Okay, for PPI we have to see the impact on the periods, okay, of the previous period for which the PPI is. Okay, and the changes in accounting estimates, if it is a changes. Okay, if it is changes in accounting policies, if it is changes in accounting estimates, we have to know the effect of that change. We have to disclose the effect of such changes in these standards. Okay, so this is all about AS5. Okay, so let's learn one by one. So before coming into the concepts, okay, I just want to show how a PNL looks like. Okay, so this is as per the schedule 3. Okay, as per the schedule 3 of Companies Act, this is how a PNL format looks like statement of profit and loss for the year ended, particulars, note number, asset, current financial year, and asset previous year. Okay, first would be income. Okay, it would be revenue from operation, and then other income, then total revenue. Okay, and then expenses. Okay, and then expenses like cost of material consumed, changes in inventories, employee benefit expenses, finance cost, depreciation, amortization, other expenses, total expenses, profit before exceptional and extraordinary items, exceptional items, profit before extraordinary items and tax, extraordinary items. Okay, so here you can see that exceptional items, extraordinary items, such items are disclosed separately. Because of what? Because of this standard AS5. Okay, so we have to know what is exceptional items, what are ordinary items, what are not ordinary or extraordinary items. Okay, we have to know that. Okay, so let's start with the concepts. Okay, so here it is: what is ordinary items, what is exceptional items, and what is extraordinary items. Okay, so first we will learn ordinary items. So ordinary items as per AS5 is said like whatever the business is occurring or incurring any revenue or expenditure related to business. Okay, related to business. Okay, whatever they are generating, such activities would be considered as ordinary items, like salary to employee, sales, purchase, depreciation, bad debts. These are all ordinary items. Okay, now what is exceptional items? So in AS5 only they have said from ordinary items. From, you have to know, from ordinary items or from ordinary activities, which means from business activities only. So exceptional items are from business activities only. Okay, so from ordinary items means from business activities only, but which are such size, nature, or incidents which is relevant to explain the performance. Okay, which are such size or which are in such nature or incident which we have to explain. Okay, so that the investors, okay, the investor or the outsiders of the business doesn't get manipulated or forged. Okay, they don't have to think like because of disposal of fixed assets the business are generating more revenue. Okay, they have to shown separately, they should be shown separately. Okay, so that the other person, the users of financial statement, doesn't get manipulated. Okay, so this is the reason why which AS5 has come. Okay, so let's see the examples. Exceptional, for exceptional items, disposal of items of fixed asset. See, you are selling the fixed asset. See, it happens once in a year or once in a 5 years. Okay, it doesn't occur regularly. Okay, so it doesn't comes in ordinary item, it doesn't comes in ordinary items, but it comes under exceptional items because it occurs very frequent, very less. Okay, in less frequently. Okay, so disposal of items of fixed asset, disposal of long term investments. Okay, litigation settlements. Okay, and reversals of provisions. So these are much less occurring items in a business. Okay, so that would considered as what, exceptional items. Now, what is extraordinary items? I hope you are able to see. Okay, what is extraordinary item? So here AS5 clearly says that it clearly distinct from ordinary activity. It is distinct. Okay, it is not from business activities. Okay, clearly distinct from ordinary activities, which is not recurring. Okay, which is not recurring frequently, and non-regular items such as huge loss from earthquake. Okay, it's not a business activity. Okay, huge loss from earthquake, it is not a business activity. Okay, like government grant, we have to refund. Okay, VRS expenditure, loss due to fire, these all are less recurring or less frequently happening items, which are not at all related to business. Yes, but it has the impact towards the business. Okay, I hope all these three items are cleared. Okay, everything is perfectly. Now, prior period items, or we all known as, we are called it as PPI. Okay, PPI or prior period, it is a very important concept. Okay, it's a very good concept. Okay, so what is PPI? Okay, we have to understand that first. Okay, what is PPI? So it is a income or expense, okay, which arises in current year, but it's actually of previous years, or the or of the years before, or 2 years back. Okay, so it is an income or expenses which arises in current period. Okay, as a result of error, or omission. See, in AS5 it has just said two things: error or omission. Okay, error or omission in the preparation of financial statements of one or more prior periods. Okay, of one or more prior periods. Okay, if you have done any error or omission of certain element. Okay, if you had forgotten to provide something, you forgotten to make the provision for bad debts. Okay, in the previous year, then that would be considered as PPI. Okay, if it has been omitted. Okay, if it has been omitted or due to some error, the amount would be different. Okay, so that would be considered as PPI. Okay, I hope you got it. Now, error, let's see what is omission. Omission means which is omitted or which is unrecorded, that means omission. Okay, now, what is error? So errors are like mathematical mistakes in applying accounting policies, misinterpretation of facts, or oversight. These are known as error. I know you already know it. Okay, now, some examples of PPI. So let's see the examples. Error in calculation of depreciation, use of incorrect rates of depreciation, omission to provide depreciation, non-provision for bad or doubtful debts. Okay, so first one is error. Okay, first one you can see it is an error in calculation. Second one is incorrect rates. We have use a different rate for depreciation. Okay, so here calculation is right, but the rate is different, which altogether means the calculation is wrong only. Okay, then comes the omission part. So here it is omission, we have omitted to provide the depreciation that in the previous year, or in back in back to 2 years. Okay, so that would be considered as PPI. Okay, and likewise non-provision for bad or doubtful debt, that would be also considered as PPI. Okay, done with PPI. Now changes in accounting estimates. Okay, so changes in accounting estimates. Okay, estimates by itself means approximation. By itself means approximation. So here, due to calculation, it's not at all our mistake, it's not at all our mistake. So there is a difference between PPI and there is and difference between accounting estimates. Okay, we have to know that. So approximates, when we have to revise, when we revise it. Okay, when a new information we get, or when more experience comes, or when subsequent developments we get to know. Okay, when basically when any changes happens. Okay, and we require that changes or the estimate to be changed. Okay, like let's take an example. If throughout the industry or throughout the company we have recognized bad debts or provision for bad debts at 2%, but it's occurring like at least 5% of the debtors are going to be bad. Okay, so it's a changes in accounting estimates. Okay, we are changing the estimate. Okay, from 2% we are going for the 5%. Okay, so that is changes in accounting estimate. So revision of estimate is not at all extraordinary item or PPI. So revision of estimate is not considered as extraordinary item. It is not an extraordinary item or PPI. Okay, like from 2% to 5%, or like we can take another example. Like if a management is thinking like a fixed asset is having a years or the lifespan of 5 years. Okay, but at the end of fourth year they realize the fixed asset can be used for more than more 3 years also. Okay, so the lifespan becomes 7 or 8 years. Okay, so that, okay, it is a changes in accounting estimates. Okay, so that would be regarded as changes in accounting estimate. Okay, but in another scenario, okay, in another scenario, if you are depreciating an asset by 10%. Okay, but in previous year you have depreciated that asset by just 5%. Okay, due to some error that would be considered as PPI. Okay, so normally, if any accounting estimates or the changes in accounting estimate happens, then it is a revision of estimate, not at all a extraordinary item or PPI. Okay, now effect of changes. So there would be two type. Okay, there would be two type. Like the period of the change, if the change affects the period only, mostly example would be bad debt. Okay, so the bad debts, the changes of bad debt, the provision of the bad debt, it's the changes, the impact happens in that year only. Okay, the other is the period of the change and the future periods, if change affects both. Okay, in the current period also, if such changes or because of changes in accounting estimates, if there are some impact happening on current year as well as in the future year, that would be an example would be depreciation. Okay, because it impact happens in future also. So uh, you have to show the change of the current day or the impact of the current year and even for the future years. Okay, so this was changes in accounting estimates. Okay, I hope you understood. Now let's get to the last topic, changes in accounting policy. Okay, so changes in accounting policy, yes. So many a times, let's take a simple example. So what is an accounting policy? So accounting policy is like a company uses certain policy or certain method, certain principles throughout the accounting procedure. Okay, so let's take an example. Like if a company is using SLM method. Okay, if a company is using SLM, straight line method, for depreciating a fixed asset, but the company thought that it's not at all appropriate, we have to use WDV method. Okay, So that would be considered what? That would be considered as changes in accounting policies. Okay. So when can this accounting policies change? So as per AS5, they have given the three scenarios. So they have given the three scenarios. One is as per the statute or as per the law. If the law itself is saying that you have to change the accounting policy, so we have to do so. Okay, as per the accounting standard. So as per the accounting standard, they are saying to change the accounting policy. Yes, we have to do so. And if a company want to show appropriate presentation, okay, so we can change the accounting policies. Okay, and we have to show what are these in its impact or the change, the nature of the change, we have to disclose it. Okay, and if we can't estimate it, then we have to disclose such facts. Okay, now the following are not changes in accounting policy. The following are not changes in accounting. So there are two scenarios. One is differ in substance from previous ones. Okay, I will get you here. And the other one is not occur previously. Okay, if the element doesn't happen already. Okay, if it has not in the previous year, then it's okay. Then it's okay. It doesn't mean it is a changes in accounting policy. And if it was a immaterial, okay, it was a immaterial, then that would be also okay. But if it differs in substance from previous one, if it differs from substance from previous one, I will take an example. Okay, so it's an example from a book only, from ICI material only. So there they have given that a company was using or was making a provision of gratuity as per ad hoc basis. As per ad hoc basis means whatever the actual payment would be, as per that they were making the gratuity. But from now onwards, they are thinking that they should change the accounting policies, which means they are implementing now a valuation officer. Okay, they are taking a valuation officer. They are asking them, okay, what would be their value that we would make a provision of the gratuity, and then applying that. So that is not at all a changes in accounting policy. That is not considered as changes in accounting policy, because it differ in substance from previous one. Okay, it is differentiating the substance from the previous one. So before it was using differently. Okay, their thinking is different, and now they are using it differently, different method. Okay, so that wouldn't considered as changes in accounting policy. This was only one example which was circulated or which was mentioned in the books, so I have mentioned that. So this was AS5. Okay, it is a very simple accounting standard. I hope you understand each and every thing. Thank you.